I want to bring in our next guest, though. That's Scott Bauer, CEO, Prosper Trading Academy. And let's take a look across some asset classes. Scott, thank you so much for joining us this morning.
Morning, Diane.
First up, good morning. Let's talk about gold. Under a little bit of pressure today. We've seen gold kind of taper a little bit. Not too much, though. It's still near the 2,700 level. What do you make of investor sentiment around safe haven assets like gold, especially in the aftermath of the U.S. presidential election?
Yeah, now that the election is over with and that uncertainty is behind us, some of these safe haven assets, maybe have cooled off a little bit. I do believe that gold is still on the rise, though. And as the pattern has held for the last, 9 months, 12 months or so, this is certainly still in my opinion, a buy the dip scenario.
Okay. You see that as a buy the dip scenario for gold. What makes you see that as a buy the dip scenario for gold?
There's still just big investor sentiment towards this asset class. There's still central bank buying, not as much as there had been over the last 6 to 12 months, but globally the amount of central bank buying is still almost at record levels. So until that momentum stops and until the whole talk of maybe the dollar decline, which we're not seeing till that goes away, gold is an asset class that both retail and institutional is going after.
Okay, and so the dollar strength does have implications for multiple asset classes.
Yep.
And so, today we saw the dollar move up earlier this week after the election. It's, kind of trading in a narrow range today. What's your take on dollar action in post-election Trump 2.0 world?
I think it's risen a bit too quickly, and we saw that because of other central banks, not the Fed, but other central banks being more aggressive than the Fed, quite frankly. Now that we've gotten this latest cut and the odds of another cut in December, there's still about 67%. That's down considerably from where we were just a month ago or so. I think the dollar is going to just stabilize, normalize a little bit here. I think we have topped out a little bit. Are we heading back to 100? No, I don't think so whatsoever. But this rapid rise that we have seen from basically 100 up to the 105 level, I think happened a little too fast. So I would be in a very cautious stance, a very moderated stance for the dollar right now.
It does look like it's moderate, at least for today. But yes, we did see the dollar pop earlier this week to levels we hadn't seen since the summer time. Is there any risk to that view that you see about the moderating more than what we're seeing today?
No, I don't really think so because of the landscape here. I think we are seeing other central banks that got ahead of the Fed, maybe with more aggressive cuts or the outlook for more cuts. I think that has moderated a little bit as well, which that all plays into, what we're doing here, what the Fed is doing here, and the impact on the dollar. So I think there's a little bit of normalization now that we didn't see over this last run up.
And then let's talk about implications of policy shifts starting next year, especially when you think about inflation and the impact to asset classes like oil. What are you paying attention to when it comes to that?
Well, when we talk about oil, I think we really just have to break it down to the fundamentals of supply and demand. And, even look at the China stimulus package that was just announced, and how did crude react to that? It didn't. It's down a tick or so. So when we talk about crude, I think we have to look at global supply and demand. And right now we have an oversupply and not enough demand. And that's why, as much as I believe gold is a buy the dip, oil is a sell the rip or sell a rally, at least at this point here. We got back up to 71 and a half, 72 or so on crude. Some of that was due to, some concern, some risk about another hurricane perhaps coming in. But right now, it is basic economics. I would not be surprised whatsoever if we see crude below 70, early next week, barring any sort of geopolitical event. Probably testing that 66, 65 level that we just recently saw.
Really? I mean, so
Mhm.
do you think that oil is more of a fundamental story, just going back to kind of the age-old supply and demand outside of geopolitical risk? Obviously, that can be a major
Right.
factor, such as any, unrest in the Middle East. But again, that's really what it's about to you for oil.
Absolutely, it is, and especially with the new administration coming in, and the motto of "drill, baby, drill." I'm not so sure that we're going to actually increase record production that we already have here, but for the near term, I don't see a scenario where global demand is going to be on the rise anytime soon.
Okay, and let's talk about yields and your expectation there. We're seeing a little bit of cooling today, 10 years off by 2 basis points right now, but we saw a pop earlier this week following the election. What's your expectation for yields post-election?
This is the wild card. It really is, and I think that many of us would have said a couple months ago that if we saw the 10-year rise from the levels it was at 360, 365, almost a full 100 basis points up to 4.5 or so where it is right now. I don't think many of us would have believed that the equity markets would have risen to all-time highs on that kind of move. So to me, it's puzzling, and it's puzzling because how can we be at all-time records when rates have just shot up like this? And can we sustain that? Well, so far, it's looking okay. And maybe that's because, yes, the economy is expected to be in a soft landing right now. But it's the wild card also because if we do see inflation start to tick up again, and if we do see rates approach 5% on the 10-year, I think that can have a very, very, very dramatic effect on the equity markets here. I don't expect that to happen so soon here. In fact, I think that this new range for the 10-year is probably going to be 4.25, maybe up to 4.75. But if we break above that on the upside here, I think that the equity markets could be, ready for a good 5 to 10% downdraft if that happens.
So that could be a potential correction if that happens. So you don't see it happening in the near term. Could you see that happening early next year?
I could, if we get to December and the Fed does, go ahead with that 25 basis point decrease, but if Powell comes out because economic data has continued to be very strong and says, oh, you know what? All of a sudden now we've got to put the brakes on any further cuts for 2026. Yeah, that's the scenario that I'm a little concerned about.
Okay, great conversation. Scott Bauer, CEO, Prosper Trading Academy. Thank you so much for your insight this morning.
Have a great weekend.